Friends, have you ever looked at your bank statement and thought, what if this was all just an elaborate illusion? What if I told you there's a financial time bomb ticking away, threatening to blow a hole in the global economy? And no, this isn't another superhero movie plot. This is about derivatives, and big banks are sitting on a mountain of them. Now, before you switch the channel thinking derivatives sounds boring, let me assure you this is anything but. These complex financial instruments are like the Wild West of finance, with trillions of dollars at stake. And if things go south, it's not just the bankers who'll feel the heat. It's you, me, and everyone we know. We're talking about the potential for another financial meltdown, one that could make 2008 look like a picnic. This isn't about fear-mongering, it's about understanding the very real risks posed by these financial instruments and what we can do to protect ourselves. So buckle up, folks, because we're about to dive deep into the world of derivatives, and trust me, it's a wild ride. Derivatives. Even the name sounds scary, doesn't it? It's enough to make you want to run and hide your money under the mattress. But fear not, dear viewers, because I'm here to break it down for you. In the simplest terms, a derivative is a bet. It's a financial contract that derives its value from an underlying asset like a stock, bond, or even the weather. Think of it like betting on which way the stock market will go, but instead of just winning or losing money, you're potentially playing with sums that would make your head spin. Now, derivatives can be used for good, like hedging against risks. For example, a farmer can use derivatives to protect himself from fluctuating crop prices. But in the hands of big banks, these financial instruments can become weapons of mass financial destruction. These institutions use derivatives to make massive, highly leveraged bets, often with little transparency. And when those bets go sour, well, let's just say it's not pretty. Let's talk about the big players in this high-stakes game, the banks. We're talking about the likes of Citigroup, JPMorgan Chase, Goldman Sachs, and Bank of America. These financial behemoths are swimming in derivatives, with exposures that dwarf their actual assets. Imagine a guy at a poker table with a tiny stack of chips in front of him, but he's throwing around bets like he's a billionaire. That's essentially what these banks are doing with derivatives. They're making massive bets with your money, and if they lose big, guess who gets to foot the bill? Spoiler alert, it's not them. These banks argue that derivatives are a vital part of the financial system, providing liquidity and managing risk. But critics argue they're more akin to financial casinos, where the house always wins and the rest of us are left holding the bag. And the scariest part? These banks are so interconnected through their derivatives trades that the failure of one could trigger a domino effect, bringing down the entire financial system. Here's where things get really scary. Remember that domino effect I mentioned? Well, imagine this. One major bank makes a bad bet on a derivative tied to, say, the housing market. It loses big, and suddenly it can't pay its debts to other banks. Now, those banks are also heavily invested in derivatives, and they start to feel the pinch. They, in turn, can't pay their debts, and the whole system starts to unravel. It's like a house of cards, and all it takes is one little push to bring it all crashing down. This is not just theoretical. We've seen it happen before. Remember the 2008 financial crisis? Yeah, derivatives played a starring role in that little disaster. And guess what? The problem hasn't gone away. If anything, it's gotten worse. The size of the derivatives market has ballooned since 2008, and the interconnections between banks are even more complex. It's a recipe for disaster, and we're all vulnerable. A stark reminder of derivatives' destructive power. Let's take a trip down memory lane, shall we? back to the year 2008 when the world watched in horror as the financial system teetered on the brink of collapse. Remember those images of people lining up outside banks, terrified of losing their life savings? That wasn't a dream, folks. It was a stark reminder of what can happen when the financial system goes haywire. And you know what played a key role in that whole mess? You guessed it, derivatives. Specifically, a type of derivative called a credit default swap, which was basically insurance on mortgage-backed securities. These things were traded like candy, and nobody really understood the risks involved. When the housing bubble burst, those mortgage-backed securities went sour and the whole system came crashing down. Banks failed, millions lost their jobs and homes, and the global economy was plunged into the worst recession since the Great Depression. Now you might be thinking, haven't we learned our lesson? Haven't we put safeguards in place to prevent another 2008? Well, yes, there have been some attempts at reform. One of the key measures was the introduction of living wills. These are basically contingency plans that big banks are required to draw up, outlining how they would unwind their operations in the event of a collapse. The idea is that if a bank knows how to safely dismantle itself, it's less likely to trigger a systemic crisis. Sounds good in theory, right? But here's the catch. These living wills are about as useful as a chocolate fire guard. They're long, complex, and full of loopholes. And even if they were airtight, there's no guarantee that regulators would actually be able to implement them in the chaos of a real crisis. It's like giving a toddler a set of instructions on how to defuse a bomb. Sure, it makes you feel like you're doing something, but in reality, it's not going to end well. Okay, so we've established that derivatives are risky, banks are playing fast and loose with them, and the safeguards in place are about as effective as a screen door on a submarine. So what does this all mean for you, the average person on the street? Well, in a worst case scenario, another derivatives-fueled financial crisis could mean bank failures. Your hard-earned savings could be at risk if your bank goes belly up. Another recession, job losses, home foreclosures, and economic hardship could become the new normal. And government bailouts. Your tax dollars could be used to bail out the very banks that caused the crisis in the first place. In short, it could be a repeat of 2008, only potentially worse. And while we can't predict the future, it's clear that the risks are real and the consequences could be dire. What you can do right now. Now, before you start panicking and withdrawing all your money to bury it in your backyard, let's talk about what you can do to protect yourself. Diversify your assets. Don't put all your eggs in one basket. Spread your money across different asset classes, like stocks, bonds, and real estate. Understand your bank's risk profile. Do your research and find out how much exposure your bank has to derivatives. Support financial reform. Contact your elected officials and demand stronger regulations for the financial industry. Stay informed, keep up with the news, and educate yourself about the risks in the financial system. Remember, knowledge is power. The more you understand about derivatives and the risks they pose, the better equipped you'll be to protect your financial future. So there you have it, folks. The derivatives market is a ticking time bomb and the big banks are playing with fire. But it's not too late to act. We need stronger regulations, more transparency, and a healthy dose of skepticism when it comes to the financial industry. The future of our economy, and indeed our livelihoods, depends on it. Let's not wait for another 2008 to realize that the system is rigged against us. It's time to demand better, time to demand change, and time to protect ourselves from the ticking time bomb of derivatives.